Okay, in this video we're going to go work through the Chapter 19 worksheet, numbers 1 through 7. If you don't have it, get it in front of you. You should have tried it by now. Let's roll here. Number 1. During the current month, the company that uses a job order cost accounting system purchases 25,000 raw materials for cash. It then uses 6,000 indirectly as factory supplies and uses 10,000 direct materials. Let's record. Okay, so the first thing we're going to do here is we buy 25,000 in raw materials. So let's put it in the raw materials inventory, huh? For cash, I think we better credit cash. So there you go. Bought $25,000 worth of stuff. All right. Secondly, it then uses 6,000 indirectly as factory supplies. So we're going to take indirect material out of here. How much was it again? $6,000. And it's indirect material, so it goes into our manufacturing overhead bucket. Remember, our overhead bucket, we combine everything indirect materials, indirect labor, and then everything else in the factory that's not direct or indirect labor. It all gets accumulated there. What else happened? 25,000 is classified as indirect labor. Wait a minute, I'm doing the wrong one. 10,000 raw materials as direct materials. So we're going to take 10,000 direct materials out of here. And we accumulate our direct stuff down here in work in progress. So here comes our direct materials in a work in process. I wonder if I can scoot that over a little bit. There we go. Oh, wrong one. Close. A little more. There we go. So that's number 3. Number 4. During the current month, a company that used a job order cost accounting system incurred a monthly factory payroll of $75,000 paid in cash. Of this amount, $25,000 is indirect and the remainder is direct. Well, there's 2 ways to do it. I'm going to show you way number 2 in the second part of this worksheet, and it's the second method that you'll find on the test. But the first method is the payroll person debits the payroll account for $75,000 and pays it out in cash. Then the second part of the transaction, the cost accountant comes along and says 25 is indirect. So I'm going to take 25,000 worth of indirect labor out of the payroll account and put it in the overhead bucket. Why is that going way down there? I don't know. We'll find out. Indirect labor, $25,000. And then the rest, which would be $50,000, is going to be direct labor. Oh, I see what's going on here. I don't know why. The direct labor is $50,000, and this is going to go to my work in process account. Hey, now we've done number 4. Number 5, the company incurred $20,000 in factory overhead costs paid in cash. So you're going to pay some overhead, $20,000 worth. This is, I'm going to put miscellaneous here. Let's see. Let's make a little room here too, huh? There we go. And that's going to be paid in cash, $20,000. Number 6, the company applied overhead at 100% of direct labor costs. So let's apply some overhead. Our direct labor cost was $50. They're going to apply it at 100% of direct labor costs. 100% of $50,000 is $50,000. So we're going to apply $50,000. And we're going to apply it as factory overhead to our work in process account. And make a little more room here. There. Okay, next, items with a cost of $5,000 were finished and transferred out to await sale. So we're going to have finished goods. We're going to take $5,000 out of there and move it to finished goods. Okay. And that'll be that. Now, one thing we have to observe, let's observe it right now, right up here in our overhead account. Right there. See, we spent 6 and 21 is 31 and 20, we spent $50,000, $51,000, and we applied $50,000. So we spent $1,000 more than we applied. In that case, we say we are under applied. And what we have to do to fix being under applied is we have to make sure we've applied all 50. So what we would do next is we would take $1,000 and add it to our applied with a credit. And what's wrong? What's wrong with all this? It all ends up in cost of goods sold. So to fix it, we would debit cost of goods sold for that same $1,000 that I just used to fix the overhead account. Okay. Alrighty then, let's move on to number 7. And let's see if we can do that. A company allocates overhead at a rate of 150% of direct labor cost. Actual overhead cost for the current period is $475,000 and the direct labor cost is $300. Prepare the entry to close over or under applied overhead to cost of goods sold. Well, how much was our actual overhead, huh? Actual overhead was $475,000, wasn't it? That's what we spent. How much did we apply? Well, I don't know. Let's see. We're going to apply it at 150% of direct labor cost. And our direct labor cost was $300,000. So we want 150% of 300,000, which I think is $450,000. What is that? That's 150% of 300,000. That's what we apply. So what's the difference? The difference is $25,000. So we incurred $475,000. We applied $450,000. It's the spent that has to be right. So our applied is $25,000 too low. We have to increase our applied overhead. Oh, how do I do that? Let's look over up here. We apply overhead by crediting overhead, the overhead account. So to increase it, I need to give it some more credits, right? And as we increase that overhead, what are we going to do? We're going to reduce our profit eventually because we'll have incurred more cost of goods sold. Remember, that's where all of our costs eventually end up. So that's why we fix cost of goods sold to adjust the overhead to match the actual.